All right, thanks, Ned. I just wanted to take a minute and thank you and the sponsors for putting this program together, and hopefully we can share some ideas this morning on the lending institutions and ag lending issues. And we've kind of pulled this and done this in two parts. Lee Fox is following me and is going to talk a little more specific about credit issues. I'm gonna take maybe a 30,000-foot level, if you will, and talk about ag lending issues. And the outline that you see there that I want to try and follow is to visit a little bit about, from a lending perspective, how we see the increased risk today in the swine sector due to losses that have been incurred, but more specifically in just the changes in cost of production and so forth that have increased the volatility in this industry. Secondly, I wanted to visit a little bit about the entire ag sector as we look at managing and evaluating risk in the industries. And then finally, I just from a real broad perspective wanted to give you a little bit of a feel for what I would say in the general overall lending environment, just less appetite for risk at a time where certainly we're seeing a lot more risk in these industries. And the reasons for that are the increased loan loss provisions that every financial institution is taking due to the recession, capital restraints, and then increased oversight that's impacting all of the lending institutions in the country. First, talk a little bit about profit and loss in this industry. My opinion is that we still have a hog cycle, we still have a viable industry, but the cycle may not be so well. I think it's changed. I would foresee that we're going to see a longer cycle in this industry than previous, where it's been somewhere around the every 4 years this industry hits a high again or a low again. And I think the fundamental structural changes in the industry are what is causing that from several aspects. One is the fixed asset investment in this industry compared to 10 or 20 years ago. The contractual arrangements, contract farrowing, contract finishing, all of the contractual arrangements that make it very difficult to unwind and cut back, and just overall more specialization in this industry than prior. And I say that the hog cycle, I believe, is going to be a lot longer, and a couple of examples, just the recent economics in the pig business. From February 2004 to September 2007, maybe arguably, but was the most profitable period in the history of this industry from a production standpoint. And during that period of time, we only added about 237,000 sows, according to USDA. So that amounts to about 1.1 or a little more than 1.1% annualized increase in the breeding herd, which very conservative growth given the fact that this industry was making a lot of money. Conversely, in the last 2 years, roughly, maybe the most unprofitable period in this industry, we've reduced 334,000 sows in the U.S. But if you compare that back to the last severe economic issue in this industry back in '98 to 2000, the industry reduced by roughly twice that amount. So certainly more difficult to get out or reduce supplies. But conversely, when times were good, we didn't add as many. So I think those issues are going to continue to elongate the cycle in this business. This is information tracked over a 12-year period of time that John Lawrence at ISU publishes, just looking at monthly profit and loss, and certainly you can see the long cycles, or what I believe is a longer cycle going forward, and severe volatility in this industry that has maybe changed to a great degree. We track, and I think most lenders are very similar, and when you're evaluating a new credit or you're evaluating an existing customer, you're going to look at a 3 or 4 year trend. I typically look at a 4-year trend because historically that's matched up with the cycles. And if you look at, again, Lawrence data and you take a 4-year rolling average ending in October of 2009, this industry as a whole, on average, has lost over $5 a head. And very difficult, obviously, when you're trying to finance the average of this industry and looking at a trend, that shows that we've got losses. And certainly, again, would point to the volatility recently in this business. I think, it's been said very well. In fact, I think it was said it's cost stupid, but certainly I concur wholeheartedly. This down cycle was driven primarily by cost of production, feed costs increases, and the ethanol issue around it. But I think there's a couple other contributors that made it difficult for this industry to rationalize or reduce supply over the last couple of years. The circovirus vaccine obviously impacted it. Commodity fund trading, and I'll show a chart on the cutout value later that shows it pretty well, but certainly as the commodity funds were invested in futures, it absolutely contributed to the fact that it made it difficult to make a decision to reduce supply when you were looking at futures 12 months, 10 months, 12 months out that were very high, maybe record high, and certainly made it difficult to make the decision to cut back. The U.S. recession and its impact on domestic demand, and I'll talk a little bit about that here in just a bit, but certainly is a significant factor for us today and going forward in my mind. Exports and the optimism that was around that, particularly in 2008 with all the exports to China. And then when it appeared like the industry may be poised to have a little bit of a recovery and make some money in the summer of 2009, clearly the H1N1 outbreak, at least for a period of time, had some impact on our ability to even follow a normal seasonal summer cycle. If you look at the Lawrence numbers, and I think this is, again, was shown here twice this morning, but it certainly is from the standpoint of a cost standpoint, the increased cost and cost of about $52, and it looks like, slightly increasing from that maybe going forward throughout 2010 based on futures. It's an issue of cost in this industry, and not so much from the standpoint of the market, although recent numbers here in the last quarter would indicate that we're looking at a true supply issue and moving meat through the market chains. I wanted to focus really on the volatility in the industry, and I think that's probably from a lender standpoint and trying to evaluate and look at risk. This industry has a significant higher risk than it has had in the past. And most of that is due to this input price volatility. This is a chart of corn prices over the last 5 years, roughly. And, certainly for most of us in the room, you can see movements in a week or less that might have historically, more movement than we've seen in a year. On a historic basis. So the volatility and the ability to manage that risk from a producer standpoint or input cost risk is going to be critical towards looking at how you finance this industry going forward and how you evaluate individual loan applications or existing customers. Again, showing just the weekly Decatur meal and the high volatility that we've seen, particularly over the last 3 years, and just how you put together feed cost and the volatility in that feed cost input, the big input in production. And again, just pointing to the fact that we want to try and figure out ways to help people, or do business with people that can manage that kind of input risk. Conversely, from the pork cutout standpoint, extreme volatility, but I'd really point out the summer of '08 there that you see where prices peaked. Clearly was sending signals to this industry that all was good and export demand was going to carry us through. And I think a lot of that obviously has changed, but it points out the fact that we just need to be better at taking advantage of some of those prices going forward while they're offered to us, and being able to manage some of that risk going forward, or lay off some of that risk to the marketplace to better manage our businesses. It's been talked about a little bit before, but ethanol obviously is the key driver in my mind in a lot of this cost input volatility. And I'd focus on the bottom. I think Steve Myers talked about the plant capacity on the top earlier, but I pulled some numbers just from the first week of November, and looking at $1.99 rack price for ethanol at that point, $120 a ton DDGs. Corn averaged $3.44 during that week, and natural gas costs at about $4.80 per million BTU. And the point is, if you look over on the right, in my mind, what I tend to try to watch on a regular basis is what is the margin over variable cost for an ethanol plant. And in this example, during the first week in November, that says the ethanol plant could pay $1.88 a bushel over and still cover all variable costs of the ethanol plant. So that ethanol plant could pay $5.30 roughly for corn and would still operate. There'd be no reason for them to shut down as long as they're covering over and above their variable costs. So certainly a competitor that at times, and most of the time in the last couple of years, can afford to pay more than we can afford on corn. So and that's just something I try to watch every week, and just to get a little bit of an indication of where this corn price might be going. Long-term trends in production, when we start looking at the pork supply, and is certainly a large increase in supply and a large increase in weights, average market weights of pigs. And I think that I'll make the point at the end, but I think this industry seems to have a bit of a problem in controlling supply, and that's something that we need to get a better handle on, and being able to effectively reduce supply. And I understand from the first slide that I showed that there are there's some rationale or some reasons, the contractual arrangements, the trying to unwind and control some of the supply is very difficult. But certainly we're going to see a cutback, and we're going to see some reduction in numbers, and that is happening, and needs to continue. Pork supply, from an earlier meeting earlier this year or this summer with Steve Meyer, he was talking about a 12% reduction in North American herd from the 2007 year end. And I'm not an economist, but certainly as I come back and look at those numbers and try to rationalize that, it made a lot of sense to me. And if you look at the North American numbers in the end of the year in 2007, we were about 7.75 million breeding animals. As of the last USDA and Canadian reports, we were down to about 7.2. So to date, or at least through September, we've reduced this breeding herd by about 6.7%. And it's been very painful. It continues to be painful, but I think the liquidation signals are fairly clear that we certainly have got to reduce this supply, and going through those steps to get that done. Canada, I've projected here, and don't know how their buyout program is going to work, but I've projected here that Canada would get down to a number that would be just about what they slaughter per year, which is about pretty consistent at about 20.5 million head per year. And this would indicate, or at 200 and some thousand sows out of that industry, that very minimal number of feeder pigs and market hogs would be coming to the U.S. at that number. But even with that, the U.S. is going to have to take a significant number of sows out of this industry in the next year or so, the next 9 or 12 months, in order to turn this thing and get the supply under control. Steve Meyer talked a little bit about production from competing meats, and so I won't cover a lot of that, but the third line in each one of those, I talk about beef production down 3.2%, but prices, USDA has projected prices, actual prices through October and then projected through the end of the year. Prices are projected to be down 9.5% for the year. Pork production down 1.9% and prices down some 17% from a year ago. Chicken down 4.3% year to date. Prices are about flat with a year ago. Turkey production's down significantly at 5.6%, and prices are projected to be down about 8%. And then I threw in and looked at milk production. If you look at the total ag sector or protein sector, production's projected to be only down about 1% year to date, and prices are down about 34%. So severe economic situation for the dairy industry. And then egg production is about flat to up about 1%, and prices are projected to be down about 24% 2009 versus 2008. So you see a total trend of less meat, milk, and eggs being produced in general, and prices being down and down significantly in many of those sectors. And a lot of that has to do with demand and this recession, and that's kind of where I want to head to with this. The USDA projections, historical numbers, and Tom hit on it a little bit in the numbers. This is kind of a chart of the same information going back to 1971, and this is U.S. beef, pork, poultry consumption per capita, and you can see the peak there from 2004 to 2007, but projecting 3 years of decline. And the issue I think that we will face is, even with the reduction in supply, we're going to be at a point where we're slugging it out with poultry, beef, and other protein for a declining market, which is going to, in my mind, going to add risk and add volatility for the next 12 months looking ahead. Looking at lender issue, kind of again at a 30,000-foot level. I mentioned before, and I believe the appetite for risk across the board in financial institution is reduced, and the reasons for that are, most all have a significant troubled loan portfolio. Loan loss provisions are astronomical, are growing rapidly. Non-current loans across the board are growing. Bank profitability is down significantly across the board, and depending on when some of those financial institutions took the hit, they may be showing some profit this year, but if you look at a 12-month or a 24-month, certainly profitability is much less. The bank stress environment and oversight, and then a lot of the driver of this going forward, initially it was kind of the housing bubble. Today, I think the recession and the lag is going to be due to a great extent the unemployment levels and the unemployment concerns going forward. I threw in a few charts here just to indicate kind of where this thing is going, and this is a chart that looks across the board, U.S. financial institutions, troubled loans, and the rate by quarter, and this is through the second quarter of 2009, but easy to see, that both the non-current loans and the net charge-offs for banks are very high, and that does impact, your appetite and ability to look at deals and evaluate risk and have available capital to grow the business. Along the same line, if you look at non-current loans in terms of real dollars in the U.S., and particularly look at loan loss reserves, the blue line would indicate about $200 billion in the U.S. has been set aside for loan loss reserve. Now, that's across all financial regulated, which is the majority of all financial institutions. But certainly the chart would indicate that, this is a stress for the banks. This is a stress for the financial institutions across the board in making new loans, in having capital available in some instances for existing customers as well in some institutions. Profitability in the financial sector is significantly down, and you can see a lot of the charge-offs that were done in the fourth quarter of 2008. But so you can level some of that out over the last 4 quarters. But certainly the indication is that the financial institutions are not doing very well as a whole, and it's due to the recession, the economy, and difficult lending environment. Total U.S. unemployment. Unemployment has, I think the last number was 10.2%. Hopefully we'll get some reprieve from that, but I think it certainly has an impact as we look at meat, milk, and egg demand consumption in the U.S. on a per capita basis. It's going to have an impact on consumption of that product. And I just picked up an article reading in the USA Today yesterday that said 1 out of 6 families had financial difficulty putting food on the table in 2009, and that's a significant number of people that it'd be very difficult to increase or even maintain meat demand for. So I think part of that we're going to have an issue dealing with, and again competing with all other proteins in a declining market. The final from a lender standpoint, from the industry or the U.S. as a credit card and the credit card losses, personal bankruptcies, certainly a pretty rapid increase in both the charge-offs on credit cards, simply, again, a factor of the recession and availability of capital, and the recession as a whole with unemployment impacting all of that and impacting how banks can operate and be profitable and have capital available at the end of the day to finance the ag industry. Most everyone's probably seen the number of banks that have defaulted this year is the highest level since back in the savings and loan crisis. I think there's been a little over 100 banks that have defaulted that FDIC has taken over so far this year. But I think that what I've tried to watch a little more than that, well, in addition to that, I guess, is the problem institutions, because that's an indication of where this is going. And FDIC publishes a list of their, or not a list, but a number of their, the number of their problem institutions, and certainly that's a growing number. Again, the general economy, ag included, certainly is impacting the number of institutions and their financial struggles. The final one, looking at quarterly change in loans and leases, and this is really where it hits the road and impacts everybody that's on the call here, is just in the ability of financial institutions to increase or take on new loans and leases in the U.S. And you can see for the last significant decline for about the last 5 quarters or 6 quarters, and very dramatic here during 2009. So there's less capital available. There's less available for any industry, and certainly less capital available are coming into the ag market. Strategies. I think as we look at strategies that producers need to be employing, in my mind, this industry really has changed from one of totally or primarily driven by production efficiency to one that to an industry that's really going to be driven by risk management going forward. And those are really the accounts that we look at and try to help them put together a risk management program or find producers that have good risk management strategies in place, because it's going to be, in our mind, the critical factor going forward. And the challenges really are with implementation of it, having the right people on staff to execute it, using a margin mentality versus trying to hit a low on corn or hit a high on hogs, but just to look at the margin and crush a margin every day. And then having enough capital to meet margin calls, premiums, whatever the strategy would be, because of the situation that we're in with producers' liquidity today, that certainly is a challenge for everyone. I threw in a couple of charts just to maybe more look at kind of the volatility again, but December hogs, there was some opportunity to lock in some profit, or not profits, but at least break evens and profits at one point in time. But certainly a number of opportunities to hedge some of that risk away. Corn futures and the volatility there, and again, some opportunities to look at setting off some of the risk in this industry. And these are both December of 2009 and historic futures, but I think the mentality has to be to look at this every day, understand what the margin on a per head basis is, and being able to execute a strategy to capture some of that profit or minimize loss. What I like to look at every day is or every week is just the revenue and margin over feed costs, and it certainly points out that producers need to understand their costs, or at least their costs other than feed costs, every day, so that they can make informed decisions about how to manage that margin, how to hedge and manage through the risk in this business. Don't pay any attention really to the numbers in there, but from my mind, I like to look at it from a standpoint of either quarterly or monthly trading, and at what level am I comfortable entering the market and laying off some of that risk. And I think that because of the seasonality in this business, I think that varies from period to period or for each quarter. And but having a written strategy, I guess, is the reason I included this slide, so that all the folks on the team understand, what the strategy is to manage or that margin and lay off the risk. And obviously the numbers that are in there are going to be dependent on, number one, your bias in the industry as far as where we're at within the cycle, a time factor, in other words, how long are we looking out, and then risk tolerance, I think, is probably the biggest one. How much risk can my balance sheet tolerate? If I'm marketing 100,000 pigs a year, do I have the liquidity to be open on the market on 25, 50, 75%, or 100% of that production? And that's, I think, what folks need to rationalize, understand, and spend some time developing a plan. Overall, from an industry standpoint, I think we're going to have a very viable industry long term in the U.S. We are, I think, one of, if not the low-cost producer in this world. If we're, in my mind, by far and away the low-cost processor in this world, with reduced trade barriers and the long-term export growth, certainly is a strength and an opportunity for this industry. And it will be interesting to see, but historically, U.S. pork has done fairly well relative to other meats in a recession. So certainly some strengths in it. Weaknesses that I see, reduced disposable consumer dollars are going to be an issue for us, I think, in the near term. Difficulty in controlling our pork supply, which we've talked about a little bit. Ethanol, although I don't think we're going to see a lot of new plants being built, in my mind, I believe, given the economics, they're certainly all going to be running, and going to be a continued demand for grain going forward. Environmental political pressure on this industry is a growing concern, and then any threat of import interruptions, again, is a concern as we become more reliant on exports.